Right. So the module that we are looking at is management accounting, which is MAC 3702. So when we are looking at MAC 3702, we will be looking at financial management. So in this case, we are saying you are applying the principles that you were doing in MAC 2602 in the previous semester or the previous year, or any other module that you were doing, maybe if you were not at UNIS. So the first thing now that we need to discuss is for us to really understand what financial management is. So when we are looking at financial management, in many cases, maybe from a layman's way of explaining the financial management, we are simply saying that a financial manager's role will just be to simply collect funds from different investors and use those funds to maximize or capitalize their wealth. Are we together? So the only thing that you need to fully understand about financial manager is that a financial manager will get funding, which we can call in simpler terms, financing. So a financial manager is going to be financed by the investors, then use those funds that he or she has received from the investors to create sustainable wealth through investments. Are we together? So when we are looking at a financial manager's role, we can say a financial manager's role will be to create sustainable wealth for the investors. Not investors, we can say these days we call the stakeholders. Right. So to just explain this short explanation there. So in this case, we are simply saying the financial manager should be able to create a wealth that is what? Sustainable. So when we are saying that the wealth that he or she is creating is sustainable, it means that whenever they create wealth, that wealth should continue. So that's why we are saying that organizations should not only look at making profits, but rather they should be able to look at other things that will affect the entity to be a going concern or to be there for a long time. That's why now at UNISA, we say that a financial manager or an organization should consider the 3 Ps. And the 3 Ps that we are going to be looking at, the first one is called the people. You look at what we call the planet, and also the what? The profit. So these 3 items, we are simply saying that an organization should actually act responsibly, because if you don't take care of the people, you might not be a going concern, because your employees might go on strike, or even the environment in which you are operating in. In this case, we are saying that when you are looking at the people that are surrounding, that is the stakeholders, the organization, the entity should look at that. The other thing, they need to look at the planet. When you are looking at the planet, the entity has to consider the environmental issues. So mostly the manufacturing companies and mining companies that usually damage the environment, the entity should act responsible to make sure that they are able to rehabilitate the environment in which they are working in if they destroy it altogether. So that's where we come now with the issues of air pollution and what have you. The entity should be able to look at that. So the other thing that we are looking at is the profit. So the profit, we know that most organizations, they're there to make profit altogether, but that profit should be able to be sustainable in the future. So in terms of sustenance now, we are saying you should not look at today, but look at tomorrow. The wealth that you are creating should also be able to be generated in the coming years. Now, the other part that we want to look at is the wealth. So there is a difference between wealth and also profit. What could be the difference? Who can help us there before we move to just see that people are following? What is the difference between profit and wealth, good people? Or if it is same? Is it the same? Who can help us? If you give me the correct answer, I will allow you to attend for next week. Good people?
So are you asking if wealth and profit are the same thing?
Yes, I'm asking what is the difference if they are different? Yes, what is the difference between wealth maximization and the profit maximization? Or they are the same? It's just a different word. That's my question there.
Well, they're not actually, no, I don't think they're the same.
Yes.
But I wouldn't know how to, define, well, if you want to create sustainable wealth, you want something that's going to last for, a long period of time, whereas in profit, you kind of are looking at that specific point in time, whereas in wealth, you're looking over a couple of years.
Yeah, we can say it's correct, but also you might want to make profit also in the coming years. I would get.
No, yeah, but I suppose sometimes, your profit can be large in some years and smaller in other years. And if it's smaller in other years, it could be because you're reinvesting back into the business to create long-term wealth, which is what you want to do.
Okay. So when we are looking at the profit now with the profit, we are saying you are trying to maximize your earnings per share. So in other words, you are just trying to say your profit for each share that has been invested in your company. So with profit maximization now, you are looking at earnings per share. Now with profit, you know that when you're calculating profit, you are going to include some of the items that are non-cash altogether. So as an investor now, they will look at the maximization of wealth. Why? Because wealth takes into account, number one, the cash flows. Number two, you are also going to look at the timing of the cash flows. And then the other one, we are saying the third one will be the risk. So you see that there is a difference between the profit maximization and the wealth. So the wealth is going to look at the cash flows. So the cash flows can come in the form of the investments and also the operating cash flows that are going to come from an investment. Then the timing of the cash flows now, that's when you're going to be applying what you did in MAC3702, where you're looking at the time value of money to say, when is that cash flow going to be paid or is going to be received altogether? Then the risk now, we are going to incorporate risk when we are going to lend, because as an investor, when you put money in the organization, you have put a cash flow and you are going to be subjected to different levels of of risk. So when you're looking at profit maximization, we are looking at the maximization of earnings per share. But when you're looking at wealth maximization, you will be looking at the cash flows that you're going to get, the timing of those cash flows, and the risk with regard to those cash flows. Are we together? So you now see the difference between the two. So if you're doing profit maximization, you know when you're calculating your profit, you'll be including other items like depreciation, the provisions, the increase or decrease in provisions, which might not increase the wealth of the investors. If an investor puts money, he expects to get a return also in the form of what? In the form of money. So they can get a return in the form of dividends, or they can get a return in the form of capital appreciation. That is the capital gains. So wealth maximization, cash flows, the timing of those cash flows, and you also look at the what? At the risk. Now, if you look at your study guide now, how they want you to be starting with, they want you to start with the analysis and interpretation of financial statements. So us, we are not going to start with that one because those are ratios. And mostly the ratios, I prefer that we do them last when we are about to write the exam, when you can cram and you also are able to interpret those ratios, because some of the things that we are going to be doing in this first chapter, in the chapters that are going to be coming, we will be covering some of the ratios that you are supposed to know. So it will be easy for you to interpret all those ratios when you have covered all the ground regarding management accounting altogether. So I'm not going to start with the analysis of financial statements. What we are going to start with is the issue of the capital structure. So the first part that we are going to start with is the issue of risk and return. Are we together? So we have identified the role of a financial manager. So we are saying is to create sustainable long-term wealth for the stakeholders. So the other part that we need to look at is, what is a stakeholder? So a stakeholder is anybody or who has anything to do with the organization. So it could be the employees, it could be the investors, it could be the government altogether, it could be the lenders of capital, which we can say the investors in the entity altogether. So those are the stakeholders. So the organization is not only going to look at the people who put money in the organization, but it has to look at everybody. That's why we said we need to emphasize the issue of the 3 Ps, the people, the planet, and the profit. Right, so with our first topic there, the first part that we are going to start with is what we call risk and return. So that's the first part that we are going to look at there. Are we together? So when we are looking at risk and return, the first part that we need to look at is that when the shareholders buy shares in a company, they are exposed to risk. Are we together? So when we are looking at the return that the investor expects to get from the investment, he needs to look at the risk. So there are 2 types of risk, but before we look at those 2 types, let's define what risk is. So when you're looking at a risk, we are simply saying that it is a chance that you're not going to get whatever you were expecting. Are we together? So there might be a chance that you are not able to get what you are expecting. So for an organization now, you have to look at risk. So as an investor, you have to look at 2 types of risk that you need to look at. The first one is the business risk. That's number one. Number two, we look at what we call the financial risks. So those are the two risks that an investor is going to face. So you know that an investor, when you put money, you expect a return from the what? From the investment that you have made. So in this case, we are saying that if you are going to be looking at a return, an investor is going to expect to get a return from the risk that he or she has undertaken. So when we are looking at risk, we are saying that it is your business risk plus your financial risk. So when we are looking at the cost of capital of a shareholder, which we can say it is KE, you are saying that the investor is going to look at first the business risk and also the financial risk. What is the difference between the business risk and the financial risk? So when we look at business risk there, so business risk, we are just looking at the risk that relates to the operating activities of the entity. So the operating activities of the entity there. So in this case, we are saying that examples, if the entity is selling products, there might be a risk that their products are not bought. So they are not able to sell. So that is a business risk. There is a risk, obviously, of competition, that the competitors might actually undercut your prices and you lose on competition, and therefore you also fail to sell. There are also other items like you sell your products on credit and your debtors don't pay. You might not be able to access suppliers in your operating activities. So if you don't have suppliers, it means that you might not be able to produce your products. So that's what we'll be looking at when we are looking at the business risk. Then the other one is what we call the financial risk. So when we're looking at the financial risk, we will be looking at the risk that relates to the level of debt within the company. So there we'll be looking at the level of debt within the entity there. So if the entity has got too much risk, has got too much debt in its capital structure, what it simply means is that there is going to be a higher financial risk. What do we mean? The entity might not be able to meet its obligations. So in terms of the interest and also the repayment of the capital or the principal amount. So those are the two things that you're going to look at. So to just for you to just see what is happening, we are saying that the cost of capital of a shareholder first is going to see, right, if I want to invest in this entity, what are the business risks that we are going to face? Are we together? So you'll be saying, is the entity going to be able to achieve its objectives? Are we together? So you calculate that and you see that's what we call business risk. Also, you need also to check if the entity has got any level of debt in its capital structure. So if it is debt, you also have to consider what we call a financial risk. So what is important now is that we should be able to understand the cost of capital, to just simply say the cost of capital of the entity. They are looking at number one, the business risk, and also the financial risk. Any questions on that before we move? Okay. But so when we have looked at the risk and the return, remember we were discussing that the investors are the ones that are going to put money in an organization. So we have got different types of investors. So the investors that we have, we will be having two types of investors. We will be having the debt providers and also the equity providers. So for the debt providers, you can look at the long-term loans, the finance lease, the bank overdrafts, the non-convertible debentures, and the non-convertible preference shares. That is what we have under debt. Then when we look at equity, equity will be looking at the ordinary share capital. You look at the retained earnings and also other components of equity. Then we also have some preference shares that are going to be converted into ordinary shares. They will be part of equity. Convertible debentures, they will also be part of equity. Why? Because in the long run, they will need to be converted into ordinary shares. So when we are looking at the debt in the organization and the equity in the organization, that's where what is going to lead us to what is called the capital structure. So these are the providers of capital. So what do we mean by the capital structure? So when we are looking at the capital structure, we are simply saying it is this mix of debt and equity in the capital of the entity. So we are simply saying that how much debt does the entity have and how much equity does the entity have? If we add them together, that will give us the total capital of the entity. So there are two important ratios that we need to fully know about the capital structure. So we are saying that there is what is called the debt to equity ratio. There is the debt to equity ratio, and also what is called the gearing ratio. So these two ratios are important because that's what we use to determine the capital structure of the entity. So what is the formula for debt to equity? So the formula for the debt to equity will be equal to your interest-bearing debt divided by your equity. Are we together? Let's say, for example, your debt is 200,000 and your equity, that is your interest-bearing debt rather, is 300,000. So all in all, the capital that we have is 500,000. So if you're going to be looking at the debt to equity ratio, it will be 200,000 divided by 300,000, which gives us how many percent there? 2 over 3. Is it 66.66? Good people?
Yes.
2 divided by 3. Right, so it would be 66.67%. So one can say it is 1, 2 is to what? Is to 3. If you just want to show it as a ratio. Then we come to the gearing ratio. The gearing ratio now will be slightly different from the debt to equity ratio, in the sense that they are just going to look at the interest-bearing debt divided by the total capital of the entity, which is your interest-bearing debt plus equity. So in this case, it will be 200,000 divided by interest-bearing debt is 200,000. The equity is 300,000. So in this case, our gearing ratio is equal to 2 divided by 5. How much do we get there? 2 divided by 5, which is equal to 40%. So that is your capital structure. So I want you to see one thing there. The percentage that we have for debt to equity ratio and the percentage that we have for gearing ratio is different. So in the exam now, you need to be able to see, what have I been given? Am I given the debt to equity ratio, or am I given the gearing ratio? All these two formulas are for the capital structure. So for you to move from the debt to equity ratio to go to the gearing ratio, you can easily say it will be 66.67 divided by 100 plus 66.67. Then you can easily find your gearing ratio. So it will be simply, so our debt will be 66.67 divided by 166.67, which gives us how many percent? 40%. So for you to move from the debt to equity ratio to the gearing ratio, you just add 100% on top of the 66% there. Are we together? So to just explain our gearing ratio is just looking at the degree to which the company's operations are funded by debt. So we are looking at the degree to which the company's operations are funded by debt. So that's also what we call the capital structure. Are we together? So that's what we'll be calling the capital structure. We're looking at the degree to which the company's operations are funded by what? By debt. Or we can just simply say our capital structure is just a mix between debt and equity in its capital. Are we together? So one would ask and say, okay, if I start a business and I don't take any debt, what effect is it going to have on my operations? Because what I do, I just raise my capital through the issuing of shares. Does debt have any advantage to me as an organization if I don't take it? Are we together? Or if I take that, is it going to have an advantage to the entity? So remember what we said about the cost of capital or the required return of an investor. Please take note, the cost of capital is equal to the what? The required return. So if I say required return or cost of capital, I just mean the same thing. So when we are looking now at having a mix of debt and equity, what advantage do we have if we look at our debt? Now, If the entity does not have debt in its capital structure, it means that the cost of equity is just business risk. Why? Because there is no financial risk in its capital structure. If you don't have debt, it means that the cost of equity or the cost of the shareholders is only business risk that is there. So the required return of the investors will only be looking at the business risk. But if you incorporate debt into the capital structure, what it means now is that you are now adding financial risk. So it means that the cost of capital might be higher, but we are going to learn different types of theories that will explain the issues of the capital structure. So the first question that I have for you, good people, we said the higher the risk, the higher the return. So it means that if you have a higher risk, you also have a higher cost of capital. So when we are looking at the two sources of capital that we have, debt and the equity, which one is more expensive between these two? Help us, good people. I like to engage.
Equity.
Which one is more expensive between debt and equity? The madam is saying equity is more expensive.
I think it is more expensive.
You think that debt is more expensive? Why are you saying equity is more expensive, and why are you saying that debt is more expensive? Remember?
On my part, I think debt is more expensive because we'll be borrowing some funds and we are charged interest on it.
Okay.
But for equity, is the owner's investment into the business and no interest is charged. Instead, they get dividends or profit.
Okay. All right. That's one other person. Another one who was saying equity.
Equity
Yes.
is more expensive because it is not tax deductible.
Okay. Somebody is saying tax deduction. Another one.
Debt, it's more expensive because debt, I'm saying it's more expensive. No, equity is more expensive because debt can be paid off.
Okay. All right. Now it's fine. I'm happy you came to class. After today, you'll be knowing which one is more expensive and why. Now, this concept is important, good people. You look at risk. Whenever there is high risk, there is a higher return. So if you need a higher return, it means that the cost of capital will also be what? Be high. So the question that you ask yourself is, who has got the largest risk between the debt providers and the equity providers? Are we together? That's the first question that you ask yourself. Who has got the largest risk? So in this case, we can see that the ordinary shareholders, they face the largest risk. Why are we saying that they face the largest risk? Number one, in terms of ranking, they will be the last to get the funds in case of a liquidation of the company. Are we together? The ordinary shareholders, they receive dividends. That lady said it, but you did not explain it well. The dividends that they receive, they are not guaranteed. Do we see that? So they are the owners, they are the last to receive everything. And we are saying that they receive dividends, and the dividends are not guaranteed because the dividends are going to be declared by the directors at the end of the year, and they might not get there. Are we together? And another thing, if the entity makes losses, they belong to the ordinary shareholders and not the debt providers. So we can look at the advantages of debt in the capital structure of the entity together. So we can easily say debt has got a lower cost than equity. Why? Because they are exposed to less risk. Why are we saying that they are exposed to less risk? The first one, when we look at the ranking, in case of liquidation, they are the first to receive before the ordinary shareholders. Does that make sense? We're liquidating the company, we first pay the what? The debt providers, so they've got less risk than the ordinary shareholders. Are we together? Another thing we can say, a debt can be secured against assets. In your financial statements, you will notice that they can say this land and buildings is secured against a certain loan. If the entity fails to pay the bank, they will come and what? Repossess or take that asset. So it's another term for isbambis. Are we together? So they are secured against assets. Are we together? Then another thing that we can look at is the issue of the interest and the capital repayments. Are paid regardless of the financial performance. Whether the entity makes a profit or a loss, the entity has an obligation to pay the interest and capital to the capital providers, that is the debt providers. But the ordinary shareholders, if the entity doesn't make a profit, they are not going to pay any dividends. So you see that debt has an advantage than equity when we look at the issue of risk. Is that clear? We can just summarize what we said before we move.
Can you please explain the last point
The number 3.
again? Yes.
Okay, so we are saying that the interest and capital repayments must be paid regardless of the financial performance. Are we together? So we are simply saying that the debt providers, they will need their interest when it is falls due. When you're supposed to pay the principal, you need to pay them. Are we together? But with the equity providers, now, if the entity does not make a profit, the entity does not have an obligation to pay dividends. Actually, what the entity can do, they can pay less dividends than what they pay in the past. Or they can say, this year, guys, there is no dividends. The life goes on together. So the ordinary shareholders have actually lost in that case. So that is why we are saying that debt has got an advantage. Why? Because they incur less risk. So therefore, debt is cheaper than equity. Let me write it down in case of emergency. Debt is cheaper than equity. Yeah. Why did we say that? Who can just help us there? Good people.
Because debt gets paid first before equity.
Right. So the first point that I want you to put, Mete, is debt carries less risk than equity. That's the first thing that you need to look at. Ne? Debt carries less risk than equity because of the following. That point that you mentioned will give the reasons why we are saying that debt has got what? Less risk. So you need to come and you state that no, debt carries less risk than equity. Number one, you talk about its ranking. They receive first or before the ordinary shareholders. They can be secured against the assets. Are we together? Then the capital and the interest should be paid regardless of the financial performance of the entity. Are we together? Then another point, that one, I think somebody mentioned it. Somebody spoke about the tax deduction. According to the organization, since now, before we look at the tax deduction there, now the entity can want to finance its investments through debt. Why are they going to be taking debt? Because debt providers, they require a lower return than equity providers. Do you understand? Because now when I'm looking at a company that is going to offer debt to an organization and a shareholder, when we're looking at these two, one of them has got a cost. All of them, they've got a cost. When we're looking at the equity providers, their cost, we are saying it is higher because they are saying that we have got two types of risk that we have: business risk and financial risk. Are we together? Then when you're looking at the debt providers, they are saying, okay, if we give you money, our money is going to be secured against assets. Whether you make a profit or not, you need to pay us our money. You have to look for other ways to repay our funds. Do we understand? Then, so that is according to the entity. They are looking now at the cost. So they're saying that the cost of debt is lower because the debt providers, they see a lesser risk than the equity providers. Are we together? Then also in the eyes of the organization, when they look at the cost, debt is an advantage. And another thing that is there, when preparing your taxable income, you'll be having your sales and your expenses. Then you also allowed to deduct your interest. Are we together? So when you're deducting interest, it means that the entity has got a lower taxable income, therefore they pay less tax. So interest is an allowable deduction for taxation purposes. So since it is allowed to be deducted in calculating taxable income, so therefore it means that debt has got also a tax advantage in the eyes of the organization. You understand? But when you're looking at the equity providers, what do you pay them? You pay them dividends. And dividends are not an allowable deduction. Remember, the dividend tax is paid by the holder of what? Of shares, and not the company. Do we understand? So for that, it will be cheaper also for the organization, because when they pay interest, SARS is going to allow them to deduct interest. Are we together? When they are calculating their tax. So therefore, the tax that is going to be paid will be less. So for that, there will be a tax advantage. Any questions, additions, or subtractions? Good people?
But now we're saying for the compulsory, what's the word? Preference, is it preference shares? There isn't any tax deduction, right? Like, you know, when you said equity can also be in a form of debt.
Can also be in the form of, okay, we have preference shares, né? Preference shares can be under ordinary shares, they can be under debt, they can be under...
Yes, so I'm saying in a case where they are under debt, then SARS doesn't take that into consideration.
Okay, now I get you there. Now, if you go to your financial instruments, I think that's FAC 3703, you will notice that preference shares that are debt, we are going to not put their dividends as in the statement of changes in equity. We'll put their dividends in the statement of profit and loss under a finance cost. But we don't have to explain that part. That's accounting purposes there. But what you just simply need to fully understand, madam, is debt pays interest, and therefore the interest is tax deductible altogether. So the issues of how to account for the financial instruments might give you problems in future. For now, just know that all debt is under, will have a Section 24J allowance. Of course, the preference shares, because they pay what? Dividends there, they are not going to have that tax advantage. That's the only disadvantage that they have. But remember, with the preference shareholders, if they are under debt, the entity will have an obligation to pay the dividend and also an obligation to pay the principal, especially if the preference shareholders are cumulative. You have to pay the dividend. If you don't pay, you're going to carry it forward to the next year, you pay them. But for ordinary shares, you notice that if you don't pay a dividend this year, there is no obligation to pay it next year. But for preference shares now, of course, the tax deductibility might not be there, but there is an advantage because there is an obligation to pay the dividend and also the principal. So, but what I just want you to go home, or you're already at home, to sleep knowing today is that debt is cheaper than equity, and debt has got a tax advantage altogether. Those are the most important things that you need to take note of. Let's not be too technical. If you become too technical, you might get lost. But I thank you, because you're saying, oh, but some debt, preference shares can be debt, it can be ordinary shares. So for preference shares that are debt, they are better than preference shares that are equity altogether, because the equity ones are going to be converted in future to be ordinary shares. But the debt ones, they are going to be repaid when they mature. All right, any other question? People? Okay. Then can we discuss the disadvantages of debt? Sometimes we were looking at the advantages of debt. Let's discuss the disadvantages of debt. Do we have any disadvantages of debt?
Losing control of your business by
Control. How?
No, sorry. That's a disadvantage of equity, sorry.
Yes, equity, we are saying if you introduce more capital, more equity, it's not control of the business. We are saying that it affects the ordinary shareholders, their shareholding. It might dilute the shareholding of the, so that one we usually use it when we are looking at the factors that needs to be considered when you are looking at the sources of what? Of financing or capital. But let's look at the disadvantage of debt.
A business may face liquidation when they fail to meet the debt obligation.
Yes, so you might face liquidation when you are not able to what? To meet the obligation. Like the point that we stated here, where is that point? We said it is secured against the assets. If you fail to pay, the debt provider will be forced to what? To make you sell that particular asset. Do we understand? Then also using debt finance might be a disadvantage because the interest and the capital repayments, they must be paid regardless of the financial performance. Now, remember, this is the organization that has given out debt. They have a risk in the sense that, yes, they are cheaper, but you have to pay the interest and the capital repayments. So that's why you see now that the debt providers, they like to give debt because they know that they carry less risk. But to the organization, it is a high risk to them because they need to pay interest and capital, regardless of the financial performance of the organization. So the question now that is going to come, that we can ask ourselves now is, should the entity have equity only? Should the entity have debt? Or should the entity have a mix of debt and equity? What will be the best position to do? And we understand that, ne? To say we have understood the capital structure, that it is the mix between debt and equity. And we have seen that debt is cheaper than equity. So when we are going to be looking at the mix between debt and equity, what should the entity have? Should it have only ordinary shares and not have debt? Or should it have a mix between debt and equity altogether? So what is the best capital structure? Now, one thing to take note of is this, good people. The cost of capital or the required return of the investors is what is called the weighted average cost of capital. Are we together? So in the calculation of the weighted average cost of capital, we will look at the weight of equity and the weight of debt. Then we multiply those weights with the cost of capital of each source. Do you understand? So the required return of the entity will be its weighted average cost of capital. So does the capital structure have an effect on the weighted average cost of capital? What level of debt and equity should be there in the capital structure of the entity? That's the question that I'm having. Who can help us? Should the entity have only debt, or there should be a mix, and to what extent? Angiti, when the teacher is teaching, you'll be getting what he is saying. So you need now also to be able to apply what the teacher is saying, to say, okay, now I need to make a decision. If I'm going to start a business, am I going to have debt, or am I not going to take debt, and why? You state the reasons, what we were saying in the past. Okay.
Yeah.
Yes, sir. Yes, sir.
No, I think a combination of the two will serve the organization best. Given one of the reasons that you have alluded to, yeah, that is cheaper, but at the same time, there is an obligation for repayment, both the principal and the interest.
Yes.
So should the business not perform well, at least you are not only faced with the debt repayment.
Okay.
You can default on the what do you call it?
Yes.
On ordinary shares. Yeah, that's my thinking. Sure.
Yeah. Remember, with ordinary shares, you're not defaulting. You are just saying we're not paying you. You don't have an obligation. Please take note. Ordinary shares, there's no obligation to pay. So if you make profits, you just tell them, this year, there's nothing for you.
Yes.
Then life goes on.
Okay, sure.
Any other taker? Okay. So you find out that other people will say, hey, I don't want to take a loan, or I don't want to take debt because of the disadvantages that we were talking about there. But remember, we said debt is cheaper than the providers of capital. Now, let's start with this. Now, when we are looking at the capital structure, we are going to be having two theories that we need to consider with regard to the level of debt a company should take on. Are we together? So the two theories that we have, number one, it is called the traditional theory. So we need to learn what the traditional theory states about the capital structure. Then number two, we have what is called the Miller and Modigliani theory. Miller and the spelling, is it Modigliani? Yes, theory. Right, those are the two theories that you can use to explain the capital structure of the entity. Traditional theory and the Miller and Modigliani theory. Now, let's start with the traditional theory. Traditional theory. What does it say? Right. The traditional theory states that the entity can achieve an optimal capital structure. So they can achieve an optimal capital structure. So the question is, one can ask, what do we mean by an optimal capital structure? So that's the first explanation. So the traditional theory, just know that they are simply saying that debt is good. That's what they are saying. Why? Because the entity can achieve an optimal capital structure. What is an optimal capital structure? So it means that the optimal capital structure is the point where the weighted average cost of capital is lowest. So it means that an entity will be able to reduce its cost of capital to a certain point where we say it is optimal. This is the point whereby the weighted average cost of capital of the entity is lowest. Are we together? Now, how do they achieve an optimal capital structure? They will achieve an optimal capital structure. How? By introducing debt in the capital structure. The cost of capital will reduce. Why is it reducing? Because debt is cheaper than equity. So in this case, what we are saying is, if the entity introduces a cheaper source of finance in the capital structure, it will cause the weighted average cost of capital to go down. Why? Because you have introduced a cheaper source of capital. Does that make sense? Is that clear?
Can you please repeat?
Okay, I think I can repeat it using this diagram. And after repeating, madam, I will ask you to explain what I've just done. Ne? Right. So let's say that this is the cost of capital. Now, remember we said our cost of capital will be looking at the business risk and financial risk. So if the entity does not have debt, there's only business risk, and the cost of capital will be the cost of ordinary shares because we don't have the debt providers. So our KE will be equal to the weighted average cost of what? Of capital. Now, if the entity introduces debt and we agreed that debt is cheaper than what? Than equity. So it means that the entity will introduce the cost of what? Of debt, which will be this one. Let me draw it like this. Right, then it will go up. You see it is going up there. Because if you have too much debt at the end of the day, your cost of equity will be high because you'll be having too much financial risk. Now, if you introduce debt in the capital structure, it will cause the weighted average cost of capital to what? To go down. But if you put too much debt, obviously, the work is going to what? To increase. So the traditional theory states that the entity will be able to achieve this point. Do you see this point? This is the lowest point in your capital structure. Is that clear? Can you hear me, good people? So in this case, this is what we call the optimal capital structure. And we are simply saying it is the point whereby the weighted average cost of capital of the entity is what? Is lowest. So by introducing debts in the capital structure, the work of the entity is going to go down because you have introduced a cheaper source of finance. Is that clear? Right. There's one point that I want to just emphasize on. If you introduce debt in your capital structure, the cost of equity is going to also increase because you have introduced financial risk. But its increase will not be higher than the decrease of the what? The cost of debt. So that's what we'll be looking at when we are looking at the traditional theory. And that is what you are going to be using to answer all the questions on the capital structure. Are we together? To say the entity can achieve an optimal capital structure by introducing debt. Are we together? How does the entity achieve an optimal capital structure? Because the weighted average cost of capital at the optimal capital structure, that is the point whereby the work of the entity is lowest. And it can achieve that by introducing a cheaper source of finance, which is your debt. Any questions, additions, or subtractions? Who can summarize what I said? To just be confident and see that I am teaching alive people or people that are listening.
Okay, so from what I understand is that
Mhm.
we are trying to get an optimal capital structure, because when we introduce debt, cost of equity becomes more expensive. So we need to find a balance in a way.
Yes.
Yes,
A
and that
balance. Mhm.
yes, that balance is referred to the optimal capital structure.
Yes. So a balance that is there is the optimal capital structure. So traditional theory states that the entity will be able to achieve an optimal capital structure. So you will see that in other questions, they will say it is called the target capital structure. Are we together? So that target capital structure, it is simply the point whereby the work is lowest. Are we together? So the optimal capital structure will be where the company minimizes its weighted average cost of capital. And this is the point where the company value is maximized. So if you've got cheaper source of capital, the value of the entity will also be what? Be maximized. Are we clear there with the
Yes.
traditional theory? Right, then number 2, we said which other theory is there? The Miller and Modigliani theory. I don't know why we are doing this one, because Modigliani. Yes, ma'am. Was that a question? All right. So the Miller and Modigliani theory says this is not achievable, what we were talking about on the traditional theory. I think if you understand it that way, to say there is no optimal capital structure according to Miller and Modigliani. Are we together? So what do they say? They are simply saying that a company should be indifferent as to whether it is funded by debt or equity. Are we together? Because we don't look at, we are not concerned about how the entity is going to be what? To be funded. So there is no optimal capital structure. That's what they were saying. So we are simply saying that the value of the business does not change regardless of its what? Capital structure, whether the entity has got debt or it does not have debt, the work will remain constant. So therefore, there is no optimal capital structure. So it is the opposite of what we were explaining. So with Miller and Modigliani theory, what they simply said is, if you introduce debt, let's say this is your KE, you introduce debt, the cost of equity is going to go up. Are we together? So therefore, so your cost of equity is going to increase and your cost of debt is going to decrease your work. So your work will remain the same. Do you understand what they are saying? That, okay, if you have introduced debt in your capital structure, you've increased financial risk. So therefore, the cost of equity is going to increase your work. But you have also introduced a cheaper source of finance. So therefore, it will also reduce your weighted average cost of capital. So the difference now will be 0. So the weighted average cost of capital of the entity is not going to change. Does that make sense?
Yes.
Yes, sir.
You lost me when you said the introduction of that is gonna increase, what do you call it?
Financial risk.
financial risk.
Yeah.
What is the correlation between the two? I thought that it's a business risk related. You lost me there.
Okay. Debt is not business risk, né?
Okay.
Debt is financial risk.
Okay.
Financial risk only comes when you are having a risk of paying the obligation.
Okay.
You understand? So remember what we had said, that the cost of capital of an investor, you look at number one, the business risk, and also the financial risk.
Oh, okay.
So business risk, this is the operations of the entity.
Okay.
Then financial risk, it is the level of debt the entity is having in its capital structure. So an investor is saying, but I'm putting money in this entity. There are other assets that are secured against debt. So therefore, I am going to meet two risks there. There might be risk that the objectives of the entity are not met, that is the operating objectives.
Sure.
Then there's also a risk that the assets that I bought, they might be taken away by debt providers.
Sure.
Are we together? So that's the point that I am actually trying to explain here, to say business risk and financial risk added together will give you the cost of what? Of capital. So an entity that did not have debt, its cost of equity will be there, which is your KE.
Yes.
It will be equal to the weighted average cost of capital because debt is not there. But the moment that you introduce debt, it will cause the equity providers to have another risk, financial risk, that will increase the cost of equity. So increasing the cost of equity will increase the weighted average cost of what? Of capital.
Sure.
Then another thing, now we have introduced debt, right? So if we have introduced debt, we said debt is cheaper, it will reduce the weighted average cost of capital. So therefore, that's why we say that the difference is going to counter the up and down. So the work will not change. Are we together? So this theory just simply states that a company should be indifferent as to whether it is funded by debt or equity. Are we together? So that's what it's saying. To say there is no need, or in other words, we're saying that there is no optimal capital structure that can be achieved under the Mill and Modigliani theory. That's the bottom line. No optimal capital structure under the Mill and Modigliani theory. And but why now some scholars will now say the Mill and Modigliani does not apply because they made a lot of assumptions which are not realistic there. Are we together? So they made a lot of assumptions that are not realistic. So therefore, we need to follow the traditional theory. So one would ask, what are the assumptions that they made? So the first one, they said the investors are rational. The second one, they said that there is no tax. Third one, they said there is no transaction costs, which is not realistic in this case. Why? Because we are saying in Mzansi, if you're an investor, you're going to face tax, you're going to incur transactional costs whenever you're buying shares or whatever you're doing. So we need to follow the traditional theory, which tells you that an entity can achieve an optimal capital structure by introducing debt into the capital structure. Any questions, additions? or subtractions? All right, so this brings us to the last part. Remember, we were talking about the cost of capital all this time. So what we need to now to do is to be able to calculate that cost of capital. So we now have a background about the capital structure, the assumptions, the theories that are there behind the capital structure, and we now know what is an optimal capital structure. We said it is the point whereby the weighted average cost of capital of the entity is lowest. So that's the optimal capital structure. So if they say calculate the target capital structure, it should not actually surprise you. What does the target mean? Are we together? The target is the point where the work of the entity is what? Is lowest, which is your optimal capital structure. So now we are now going to learn how to calculate the cost of capital. So, first question, what is the weighted average cost of capital? I see in your second year, you were calculating your weighted average cost of capital. What was that? And what do we use it for? Matwamti, good people? What?
Cost of capital is the expense we incur for taking debt, or I mean for getting finance.
Okay.
I don't know how to say it, but for source of finance.
For the source of finance. But the problem that is going to be there is when you say expense, because with ordinary shareholders, you pay dividend, there's no expense there.
But I'm referring to that as an expense.
Yes, now I understand. But I'm saying, take note there in terms of expenses. I mean, when we are looking at the weighted average cost of capital, let's simply say it is just a return that a company needs to achieve in order to fully compensate debt and equity providers of the company. Are we together? So we are simply saying it is the return that needs to be achieved by the company in order to compensate the debt and equity providers of the company. So in other words, your weighted average cost of capital is the required return of the investors. So in other words, what we are saying is, if the entity knows that its weighted average cost of capital is 10%, whenever they are going to make any investment, they cannot take an investment that will give them a return that is less than 10%. Why? Because their capital providers, they need at least 10%. So in order for them to get or to create wealth for the investors, they need to make sure that they get a return from their investments that is above the cost of capital. In other words, the weighted average cost of capital. Do we understand?
Yes.
All right. So
Sorry, I think with me, I battled to find the right English word, the return.
yes, it is just the return. I need, because as
Yeah.
an investor, please take note, investors, what return do the investors need? number one, investors, they might need a return in the form of interest. That is debt providers. I mean, debt providers, they will need a what? Interest. Then for the equity providers, they will need dividends and also capital gains. That's what they want. So that's the return that the investors will be looking at. So we will use the weighted average cost of capital when we are doing capital investment appraisals. We are going to cover this one also in this topic. So when you're looking at capital budgeting, we are going to use the weighted average cost of capital when we are looking at the valuations. Then we are also going to look at the weighted average cost of capital when we're calculating our EVA. So our EVA will not be part of our syllabus. So life is good. So we'll be looking at capital investment appraisal and the evaluations. The economic value added will not be a part of our syllabus. We'll do them next year when we are doing our CTA there. So how do we calculate the weighted average cost of capital? Our work. So when we are calculating now, so this thing of just doing calculations throughout and not explaining, when you get into the exam, you fail to explain what you were doing in the calculations. That's why we first give you the background information. When we get into the questions now, you will be able to analyze and interpret the information that will be given. Is that clear?
Yes.
Yeah. Right. So the weighted average cost of capital, good people. When we are looking at the weighted average cost of capital, the formula is the weighting of debt multiplied by the cost of debt plus the weighting of equity multiplied by the cost of equity. One will ask now, what do we mean by the weighting and what do we mean by the cost we now know? Ne? The cost is the required return of an investor. The question is on the weight. Now, the weight now, what you do, the first thing is to identify the sources of capital. You state the value of that capital. The value will help you to calculate the weight. Then you multiply that weight by the cost. Then you get your work. Now, example. It's coming from my head. Let's say that the entity has got ordinary shares in its capital.
I didn't catch that. Could you try again?
This one's ordinary shares. Has preference shares. Let's say it has got debentures. These are the sources of capital that the entity has. Now, let's say that the ordinary shares are 100,000. The preference shares are 70,000. And the debentures are 30,000. Let's say that the cost of equity is 10, preference shares is 8, debentures is 6. That's an assumption. I just want to show you how to calculate the weighted average cost of capital. The issue is about the what? The weight. So how do we calculate the weight? So now looking at the weight now, you first look at the value. So the value can be in the form of book values. With book values, you take the amounts as they are in the statement of financial position, or you can take the value in this form of the market value of that particular source or financial instrument. So we will learn how to calculate the market value of the instruments, how to calculate the book value of those particular instruments. So in this case, the total capital of the entity, you will add all the items that are there out together. 100 plus 70 plus 30 will give you a total of how much there?
200.
Of 200,000. So when you are looking at the weight of capital, which was your gearing ratio in the first part when we were looking at the ratios then? Ordinary shares, we are saying how many percent are the ordinary shares of the total capital of the entity. So in this case, I can see that my ordinary shares are 100 and the total capital of the entity is 200. So ordinary shares, the weight will be 100 divided by 200, which gives us 0.5. Do we see that? Good people? How we calculate the weight. Then the preference shares will be 70 over 200. 7 over 20, what is it? It is 0.125. 70 divided by 200, it is 0.35. Okay, and then debentures will be 30 over 200. 30 divided by 200, which is 0.15. If you add them together, they should give you 100%. Is that so? 0.15 plus 0.35 plus 0.5, getting 1.
Yes.
Now we're together. So remember our formula by saying it is the weighting times the cost. So in this case, our weight is 0.5, the cost is 10. So it will be 0.5 times 10, which gives us 5. Then 0.35 times 8, 2.8.
2.8.
0.15 times 6.
0.9.
0.9. So our work will be the total, which is 0.9 plus 2.8 plus 5. 8.7. Happiness. Are we clear?
Yes.
How to calculate the weighted average cost of capital? So the issue now, we are now able to calculate the weighted average cost of capital when we are given the information. The question now will be to calculate the market value of each source and the cost of each source. Is that clear? So in our next class now, we are going to learn how to calculate the market value of ordinary shares. How do we do it? How do we calculate the market value of preference shares? How do we calculate the market value of the debentures? So I'll give you the notes and the things that you are going to be looking at to have shortcuts to calculate all these items there. Are we together? Ordinary shares, market value, preference shares, debentures. There will also be other instruments like long-term loans and how to calculate the target weighted average cost of capital. So all those things are the things that we are going to be looking at there. It's 8:59 now. We are going to end here. Then next week, we are going to start to learn how to calculate each instrument. Okay. So we just maybe 3 minutes. I can extend by 3 minutes. We can start by looking at the ordinary shares. Now, when we are looking at the ordinary shares, first thing that we can learn is to calculate the market value. So the market value of the ordinary shares will be the issued number of shares, number of issued shares, multiplied by the market price per share. So what you simply do is to check how many shares does the entity have and how many shares does it have, and what is the value of each share. So we'll do examples as we are going. Then when we're looking at the cost of ordinary shares, which is our KE, there are two methods of calculating your cost of equity. The first one is called the Gordon's growth model. This is when the entity is paying out dividends. So the Gordon's growth model says it is the expected dividend divided by the market price plus the growth rate of your dividends. So we'll learn how to calculate our G. The market value most of the time will be given, and the expected dividend, which is your current dividend, which I'm going to call DO 1 plus G. So these are the things that we're going to be explaining in the coming weeks now to apply this formula. Then the second one is called the capital asset pricing model, which says it is your risk-free plus beta RM minus RF. So we'll explain what we mean by the risk-free, what the beta is, what RM minus RF is. And when you're given a scenario, since you know that there are these two methods, how do you see which method you are going to apply in the question that you are given? Are we together?
Yes.
Any questions, additions, or subtractions? Silence means confusion or what? Are people confused? I'm sorry for confusing.
Yeah, more info.
Oh, all right. No, it's fine. Yeah. Let's meet next week.
Yes.
Let's meet next week. So if you are interested in joining classes, I'll share the registration form. Also, this video, I think we'll share it for free. But the classes coming forward will be for people who have paid. So we will share as we move. So in
Do you
the
not, do you not offer classes for 3703?
yes, we do.
Okay, so we'll register them on the same registration form you're gonna share.
Yes, or actually all the modules that we offer will be there on the timetable.
Okay.
If there is a clash, it means that you are going to attend class during the week. Don't attend the weekend because we'll be repeating the same things. Or sometimes we'll cancel the weekend class. Certain classes will be there during the week and others will be there over the weekend. So please take note. But if your situation is not controllable. You can just watch videos instead of attending live classes. You will just be asking questions. But if you took your modules nicely, you won't be having any clash. So you'll be attending during the week and also weekend.
Ngobani,
Yes, ma'am.
when is the MAC3703 free class?
No, that one ayikho.
How kanjani?
Why?
We just selected the difficult modules. Then we just said, no, let's take this one, let's take this one, let's take this one. Because it was supposed to be there weekend. But there were other modules that were being taught. Like weekend, we did the FAC 3701. There was FAC 3702. There was text. So the time couldn't fit there. So that's why there's no free class. You can just attend. Or you can just request for a video. Yeah, I know it's fine. I'll talk to the tutor if he can. But he usually doesn't want. Yes. So there's no free class for that one. There's no free class. Why do you want free classes?
We want to.
You see, if we're testing waters.
All right. So now if you want to register, please make sure that the number that you are using, good people, is this one to send your registration form 0788 565 885. If it is not that number, it is not Oxford. Now, people are now doing this. They're taking our videos and giving students videos there. Then as time goes on, you don't get your videos. Then you call me because I'm Oxford, but you did not register with us. So make sure that you get the recordings, you are added by me in the group. You are also going to get the registration form and send it back to me, and you are paying in the Oxford Tutorials account.
Okay.
Yes, Oxford, nothing else. All right,
You you don't have it.
we do have the class, ma'am. No, the previous madam was asking, Uti, do we have a free class? I was saying, no, the free class. I need today, we just said that people.
I also want to be added in FAC 03. Then I have to use this number.
Yes.
Okay, all right. It's fine. Thank you.
Yeah, please use that number. There's
Okay,
one number again, but I'm saying just use this one. Or just use the numbers of the administrator in the free.
Okay, all right. Thank you. Hello.
Yes, ma'am.
Do you also offer auditing 3702?
Yes. Right.
Oh,
if you're
okay.
doing accounting sciences, okay. If you're doing accounting sciences, I need
Yes.
everything. And all your tutors are chartered accountants. So don't worry if you are looking at qualifications or whatever. All your tutors are chartered accountants. But anyway,
So also on the registration form, there will be the amount also, how much is per subject or the
okay,
bundle or everything.
it's 1.5 per module, madam. That's the price.
How many classes?
Then you divide it by 3. The classes are there until you write your exam every week. So you find out that sometimes in 1 week you can have 2 or 3 classes. Maybe you want to cover an area, or maybe there is an assignment that you are supposed to do, or things like that, because we'll be discussing everything in class to make your life easy. Yes.
Okay.
All right. But one team, if you have other questions, you can just send a WhatsApp message on that number.
So we divide by 3, meaning 3 payments.
Yes, 3 months, 500, 500. The semester is short, so you can't pay until December. We'll be out together. So make sure that you attend. All right. Yes, sharp, good people. All right. Sebo.
Bye.
Thank you.
Sharp, sharp.